All right, Rhett. Well, I am super excited about getting this thing going. I've been following a lot of stuff that you guys have got going on. I can't say thank you enough for joining us. So, why don't you kind of kick us off? Tell us about you, about LoanPro, and then I can share your deck and we'll get started.
Awesome. Well, appreciate the opportunity. Close connection and friend, but also your professional pursuits and the footprint that you guys have. I know you make a really big impact in so many people's lives, being a trusted source, and we appreciate the connection and relationship. So, just very briefly, my name is Rhett Roberts, co-founder here, actually with my two brothers, of a business called LoanPro, and we provide software to support loans. And so think of it as a modern or an AI powered platform to do all of loan servicing. And our customers, so we really serve three different markets. The first is private credit, second is banks and credit unions or financial institutions, and third is credit card. And our customers kind of span across all of those areas, meaningful footprint across the United States. Double-digit percentage of the US population has open active accounts within our platform through our customers. So it gives us a really interesting view of what is happening, as well as some impact by unlocking some of the historical handcuffs folks have had from maybe the technology stacks that they've used and all things around credit products. So we're excited to kind of dig into the weeds a little bit today and see where the conversation goes.
I'm excited. And just real quick, you guys have been a proud supporter of BHB, a sponsor, and I can't say thank you enough. You guys ensure that we continue going down our journey. So, thank you for your support as well.
Well, you bet. We believe in it. We think being a good member of the community is an important responsibility. We plug in with a few of those here in the area I'm from of Utah, and that gives us an opportunity to do what we're going to talk a little bit about today. This idea of, hey, together we can create tomorrow rather than just waiting for it to happen. There's no reason that we can't be the ones who make tomorrow happen.
I love it. All right. Well, I've got your slide deck pulled up. Rick and I have studied. We think we're ready. So we're buckled up. Start driving, my friend.
Awesome. Yeah. So I think there's so many things that are really exciting about the opportunities that we have in the marketplace today. And one of those is if you go and talk to different lenders of the three different areas that I spoke about, maybe private credit, banks and credit unions for sure, and also the credit card issuers might be through a sponsor bank model, it might be through, co-branded or direct issue. They all have a similar challenge, and that is when someone designs a lending product, they can be constrained by what the technology does. So if you think of the constraints on when you're going to design a product, be whatever kind of product it could be, we start to see a lot of these hybrids in between installment loans, lines of credit, maybe with access with a card or not. You're going to have constraints of what are the rules for that program. And those rules can come from different regulators. We sort of call it the alphabet soup of different government agencies. Everyone has a little bit of opinion. So let's take a financial institution that's publicly traded, right? They're going to have the oversight from the like FDIC, for example, or OCC, a CFPB, but they're also going to have like the FFIEC and many others that are going to distinguish and say these are the rules you need to follow, not only in the credit box of the types of loans you give, but how you administer and manage those loans. So, for example, imagine you put your hat on of being an investor and you want to buy different stocks of different banks. And in order to compare apples to apples, you want to see the portfolio performance of those banks. So think of a standard similar to like an accounting gap standard where the portfolio performance of the FFIEC will distinguish certain rules that these publicly traded banks need to follow. And so, keep that hat on a moment of being an investor. If you're going to do an evaluation of how a portfolio is performant from one bank to the next bank to make a determination of who you want to invest in, they probably should have the same definitions of certain words. So things like, is the portfolio, is the borrowers or the loans that are inside of that portfolio, are they current or are they delinquent? Well, you would think that it is a universal term, but it's not. And so if a customer has $100 due per month and they pay $97, are they $3 delinquent? Or did that hit some kind of a threshold where it takes the $3 they missed and move it to the back of the loan? And there's a lot of rules around that. Or if a borrower calls in and says, hey, something happened in my life, can I change my due date? Well, what are your rules? Is it just up to the person who answers the phone, or is there certain hoops they have to jump through and qualifications? And so government agencies like the FFIEC publish standards, but there's also bank rules, maybe program rules, capital requirement rules, and so forth. And so we want to talk a little bit about those and how you build technology to support that. But also, one of the constraints that can happen when someone designs a lending product is that they can be constrained on what their technology stack does. So think today, for example, in the point of sale financing, which could include a subset of that could include buy now, pay later, where most of them are doing pay in four, primarily because of the definition of loan inside of some of the regulations. So think of like the Reg Z. When you go in and look at Reg Z, where TILA disclosures and things are happening, the definition of loan is more than four payments, right? Installment. So they're staying four or less. So if somebody wanted to make a pivot on duration and say, oh, now let's just move from a term of 4 to 6, that puts them within the framework of all of the regulation they need to follow, certain licenses and a bunch of hoops to jump through. And sometimes a little pivot like that would prove they need different technology and the technology stack to support different really unique products, but also some pretty vanilla ones as well. And so that's what we thought we'd talk about today is what is personalized lending? How do you do this embedded distribution and meet the customers where they're at, making it convenient, removing friction? And then, of course, a big topic these days is stable coins and where do we see the future there? So hopefully that's a little bit of warm up, Matt. Just to jump in, love to hear your thoughts as well.
Man, I love it. Hey, I would love to be in the room too, right? I mean, if you walk in, you say, look, let's take everything off the table that we know today, and let's just create a really cool product. And then we'll
Right.
come back in with the rules and the regulations and everything. You guys have really just created a very unique technology stack. And I would have loved to have been in that room just for the record, just to listen in and see how that was all going.
Yeah. I was at a conference this last week. We hosted a customer advisory board actually at Sundance Ski Resort here in Utah last week and brought in like 50, 60 of our customers. We get a great feedback loop from them and we put on some great content and material and as well. And we had a guest speaker who is extremely, former CEO of a bank, had previously been nominated to the Fed, had like an amazing list of credentials. And it was fun to listen to the different topics he was bringing up. But one that he'd mentioned, just a little bit of recency bias, that he's involved in something that's common in this industry for banks and credit unions is the increased consolidation, mergers and acquisitions. And we were talking about why. What's the trend there? We have, the number of banks are merging. Of course, there's now some new ones that could be launched with some new charters. So the trend that we're seeing, but the consolidation size. And he had mentioned that this one bank, they were a single branch. They had a single product that only offered mortgage. They hadn't launched a new product since the 1990s.
Jeez.
And so some of the challenges, and so you start to interview why. Why didn't they do that? Well, maybe there's a cultural thing, maybe there's a footprint thing, there's a few others, but it includes the technology stack, barriers to entry. How do you serve different markets? How do you cross sell? And we hope we can solve some of those problems for our customers to reduce that friction for them to be able to stay relevant and also meet the needs of their customers through the different kinds of programs.
Well, it's important too. I'm going to get on the soapbox for just a second, being that banker, right? I
Yeah.
remember we got a call one time that our board of directors, when I was at Happy State, the loan took him like 90 days to get a piece of equipment loan. Should have taken like
Yeah.
30 days. And so we pulled everybody together, pulled in compliance, pulled in loan operations, pulled in a lender, and said, "All right, look, let's take everything we know, all the rules of the road, and let's throw them out, right? And let's talk about how should this process go, and let's build a process without that, and then we'll come back and say, okay, what step do we need to have a little compliance? What check do we need to have a little loan operations?" And as we realized, we took that and we shortened that 90-day window down into about 18 days. And honestly, we could get to a decision in 72 hours, but we had to go get a few of the checks throughout the place. And I just say that for if you're a banker on the call and you're listening to what Rhett is saying, it's so important to get in the room and say, let's not think technology, let's not think these things, let's figure out the best possible way for our customers. Then we come in and talk about the how, right? Let's solve these problems. And we called it our happy fast pass. I know that probably shocks you coming from Happy State Bank, right? But as you go through there and you start finding these different things, man, we started churning out for our really good customers, and then some how to get these decisions faster, so therefore they know if they can move forward or not. So love what you guys are doing.
100%. And I'm there with you. And we've only stayed on the first slide, but there's so much, right? We've got, if you think about what's involved in why would you want to launch a new product, or how do you optimize a system or a process for your desired outcomes? And I think where the best place to start is to define your outcome. What do you want it to be? So in this case, are they trying to increase approval rates? Are they trying to do conversion rate adjustments? Are they trying to speed up the process? Are they trying to reduce the hassle factor? Are they trying to increase an NPS score? There's a lot of different things to solve for. And so what is your desired outcome? And it sounds like I'm stating the obvious, but I've been through this process thousands of times over 20 plus years of a career. And that's perhaps the fastest cheat code, is to know where you want to go. And if you
Absolutely.
can define where you're wanting to go, it will help. I'll just give a single example and then we'll jump into this deck. But the example process when you had a bank we were working with that did SBA loans. And everybody knows the origination process in SBA, you got to jump through all these hoops. There's fairly rigid like frameworks and applications and things to fill out. And then you got to wait for an answer. So you're actually like offloading that answer to someone else as you make your own answer. You get better over time, your Venn diagram of knowing what's going to get approved. And so you can have a pretty high conversion on maybe stating it a little bit earlier. But if you look how long it takes for a medium-sized business to fill out the loan applications, it's multiple days. There's a lot of paperwork. There's a lot of stuff involved in the journey. And this bank we worked with was trying to optimize the speed. And the thing is, we sat down and discussed what they wanted to have was they had a challenge that they would work with their customers. Maybe the customer had a sizable balance inside of a checking account, has multiple trade lines and engagements with them, and they want to get an SBA loan. And they were irritating their customers because their customers would jump through all these hoops and there'd be like a wait and see game. And then down the road, multiple days, they would get a decline, or I need another document or this or that. And the thing they want to optimize for was, let's reduce the hassle factor. If I'm going to say no, let me say no fast.
Right.
So I don't like eat all your time. And that's fine if I say no, but let's do it pretty quick and let's move on. And so just reorganizing the steps, optimizing for customer delight is a significant improvement. What they found is, one, they were able to actually close more deals because they're being much more upfront. They're being very candid with folks. So the people who spent all the time going through the journey were actually the ones that close. And so you can have like this hassle factor like score up front. But you also are getting the people you say no to, they're fine with it if you say no pretty fast. They're pretty irritated if you drag them out for a long time, and then you might lose the banking relationship. And
Right.
so just those sort of like, they feel like common sense, but sometimes we lose the sight of what we're trying to do when we get busy into like workflows.
I love it. Well, last soapbox. We got to slow down this M&A. I think that we're both coming up with great solutions. Let's dive in. Let's launch some embedded lending, my friend.
You bet. All right. So I got up on the slide here. I'm not going to read it out to everybody, but this concept of these three steps, right? You got to pick the right team when you want to do an embedded lending. So generally what happens is folks will choose their distribution channel. So let's take one example of embedded lending is point of sale financing. There's a few other ways, but let's take an example of you go to a dental office. And while you're at a dental office, my oldest son just barely got his braces off this last week, which he's pretty thrilled about. But that cost me a boatload, right? I paid two different rounds of braces, and in different financial circumstances, folks may want to finance that. And if you wanted to provide an embedded financing product for braces, how would you do that? Well, you probably need to put it inside of point of sale, make it really easy for the dental office to click a button and have it be streamlined rather than completely separate to where they need to fill out a different application and so forth. So think about how you would support that in a delivery, but there's also, how does the product run? What bank are you working with? What license are you engaged with? What's the credit box? And does your credit box have a high overlap with your distribution channel? So, for example, this dental one, you're generally not going to have super A paper that's going to be financing dental procedure, right? They're going to pay cash for the most part. So you're going to be mid in the credit worthiness category. Well, does your banking partner, does your where your money comes from, does all of those agree upon that? So I've seen over the years, folks get pretty far down the road and then recognize there's not a high, they chose partners that they're not fully congruent with one another for the product they're trying to launch. And so just picking the right team, and that's really key. And then where to get started, right? We're going to jump through a few steps, but I think it's best to go ahead and structure this out like in a RACI diagram. Who has what roles and responsibilities so that you can launch products, but you can also match the project management in a fast and what I found is more transparency is better. If you're working with a banking partner, sometimes they're going to provide the license. Potentially there's a cards, there's a BIN sponsorship. Often they're providing the credit facility or the capital to do that. Sometimes they're going to be the capital for a period of time, and then you're going to either pony up your own balance sheet or you'll go like sell it in the market or use a credit facility. All of these different partners are key, and we've helped many, many customers launch this. So I think that's a key piece. And then, of course, your project management side. How do you launch products quickly, learn things pretty fast, and then adjust your product and have your partners aligned in a way that you can do that? If you go back, I don't know, a couple of years in the past, lots of folks would take maybe 6 months to launch a product.
Mhm.
Well, in an embedded distribution, how much changed in that timeline? Well, a couple of years ago, interest rates were coming up rapidly. We worked with one client that was coming from a historical banking platform that they were used to moving in like, annual release cycles. And when you plan out all of next year, things might change. And so what this does is it takes some of that planning and moves it into iterative cycles where you can take real world feedback and modify and adjust your programs. If that's to cut a loss rate or if that's to capture a different market size, there's a few reasons you would do that. But these are kind of the three basic steps of how you would approach an embedded lending model. And I think that's been successful. I know, Matt, you have many, many partners, part of the organization that fit different seats here.
Yes, absolutely. Walk me through, like, I hear so many bankers ask this question. Dave and I talk about this a lot, right? Banks are always saying, how do I get started? What does this even look like? Walk me through real quick, stick on that project management theme, the MVP,
Sure.
the minimal
Yep.
viable product. Like, what does that look like and how do they get to this yes to get something going?
Yeah, well, it's a great question. So since this audience is primarily from the banking perspective, right, you can put a few personas on of what seat do you sit in the process of launching a program. But generally, the long pole in the tent is going to be the compliance review and the banking approval of the product. And so, one way to get started and to to fast track that is going to get preferred partners pre-approved. So, we do this with a number of banking partners that if the lender or the brand is running on the LoanPro platform and they choose a list of different partner banks, we're already pre-approved with them. They've already gone through, we have all of our certifications as the system of record and the PCI certifications, the SOC 1 and SOC 2, and on, all these things. But also, they've gone in and we've configured programs in the platform part of our partnerships with those partner banks where all of their business rules and things are set up. What happens on delinquency and small dollar write off and a change due date, all these things we call loan life cycle processes. We pre-configure them and the bank approves them through a process. And then when there's like a marketplace lending product that's going to launch with that partner bank, then they basically start with that instead of a whiteboard. That speeds things up significantly. And so I think that's one place to start is if you're the partner bank and you want to create a program that you can get some velocity, rather than reinventing the wheel every single program, go ahead and create some standards, choose your team. These are going to be different partners like LoanPro, and depending on, maybe there's if it's a credit card, it's going to be issuing processor. Maybe there's going to be some oversight and management. And then the second piece would be have very clear requirements. If you're the partner bank, you need to ask the parties, maybe the brand or the marketplace lender who's going to launch a product, be super straightforward. Like if they don't have a head of compliance, then you don't move to step two, right? Probably don't go 50 steps down the road and then be like, oh, by the way, you need somebody to run compliance. And so just be really standard. Like these are the team players you need on your side. And so let's go ahead and go. I'll help you fill your roster. And so I think just the huge level of transparency will be a value add from sitting from if you want to launch a partner banking business model.
I love it. I've talked to a lot of good banks that's been out there. They launched these programs, and a lot of them talk exactly what you just said. So couple things I would say too. I'm just going to reiterate what you said. I call in the Department of No, and I remember I worked in IT for a while, so I was part of Department of No. I get it, but if you bring us along in the journey at the very, very beginning, right, and let us understand the why. Let's talk about where we're headed, and then let's figure out how to kind of put those airbags up. So if we do run off, we don't blow ourselves up. So I love that, right? You start off with something small, create your standards, and move forward. But bring the Department of No, bring people like me along in the beginning, so we don't cut you off right when you're close to the end zone and make you get a 20-yard penalty. That's not fun.
And what you'll find is if you do that and be transparent with your own internal team, hey, look, we're going to try this. This is the maximum budget we're going to do. We're only going to give X number of loans. We're going to run this cycle, get a proof point, and then repeat. I think you'll find more yeses than nos. Because what happens if you try to launch the whole kit and caboodle on step one? A compliance, even IT, everybody's looking at the most extreme examples. And so, like, we have one client, we're coming into tax season. We have several clients on our platform that are software related to tax filings and some various different organizations. You'll know many of their names. But during peak season, as folks go through and fill out a tax return of like 1040s and they get a early access to their tax return, or if they now that this provider has the ability to see what their financial state is, links to their bank account, see their tax, helped create their tax return, they offer them a unsecured personal loan. And during peak season, these folks are creating north of 50,000 new loans per calendar day on the LoanPro platform.
That's
And so if
amazing.
you see that, well, they didn't do that on day one, right? They launched a program. They said, let's do like 5,000 loans in this, and let's try this out. Let's learn a lot. Let's tweak, adjust. Oops, we didn't think about this. And so just think of the sequencing steps. You don't have to eat the whole world in your first bite. You get to break it into pieces and then you prove what's successful. I've never one time in my career seen the very first iteration be the final state, right? Everybody wants to evolve and change it over time, as they should. And the challenge is if you approach compliance or IT or any stakeholder, they're looking at the outer edge. Okay, what happens if this thing starts doing 50,000 loans per day? What happens if the volume and scale? And so they're underwriting, if you will, the edge case when that's maybe not what you're going for. So being very transparent with your own internal teams for approval is key as well.
Right. Very well put. I do think embedded lending is going to be hot. Banking's cyclical. Everybody's begging for deposits. I think lending will come back pretty quick. So now's a
Yeah,
good time to be having these conversations.
I agree. So let's move to the next slide if that's okay.
Absolutely.
For this audience, what I think is really helpful is going back and reading a little bit of history and looking at the origins of co-branded credit cards. So go to a Barclays or one of the players that does this, and they're basically brands who are looking for an alternate rel to monetize their brand and their goodwill they have with the customer set. But they don't really want to run the program, right? They don't really want to do all the stuff. They want to take their brand, a delivery mechanism. So think of like a big brand that isn't primarily in financial services. Think of somebody who loves Disneyland or Disney World, and they can get points to do their annual trip to Disney, and they'll choose a card because of that. But they also want to put Disney card art and whatever on the card. So they're going to choose it because of its brand. And some have really turned this into major businesses. So basically, every US based airline is not a great business without their credit card, right? So that's an interesting piece. So some have gone really far. Most co-branded cards have not gone quite that extreme, but there's a lot of in-betweeners. And then fast forward to today, and look at the technology advancements where embedded lending can intercept some of the co-branded cards and keep your brand or keep that brand front and center. And I tell this story often about when a feature that LoanPro ended up creating, we've got a number of patents on it. We're really proud of this idea called transaction level credit. And I've shared this with you, Matt, and a few others in the past, but some number of years ago, I mentioned at the beginning, while people were joining, I've got 4 kids. My wife and I were in Costco, and we've got our cart full of food, and we're waiting in line. And the guy in front of us, he didn't have a cart. He was just under his arm. He was holding this huge thing of toilet paper, and in his other hand, he had a little box. And he went to check out. He scanned his membership card, and I looked at his the price, and I ended up talking to him because I thought that was a very large price for a big thing of toilet paper. And it turned out he bought a big thing of toilet paper and a 10,000 something dollar diamond ring in the same transaction. And I just thought that was so peculiar. First, there's not a lot of places you can buy those two things together. And so it was just sort of fascinating. So I talked to him afterwards. I said, "Hey, you just paid for that on your credit card. Why?" And he basically paraphrased and said, "Hey, I know I could have got a better financing deal on this diamond ring. Lots of places have sent me things in the mail that I could get 0% interest for 6 months or this or that. But you and your family and everybody else is waiting behind me in line. And I got to hurry up. This thing's got to go quicker. I had to wait in line to buy this thing. I'm not going to slow down the line by filling out a credit app and it takes 15 minutes and blah, blah, blah." And so I really thought about that and said, well, why do we make it so complicated? Couldn't he just pay for it on his card and then roll that off to the right financial instrument post transaction when he's not waiting in line? So we started going down this route of there's a lot of convenient ways of providing embedded lending. Maybe it's access through a card network or an alternate network, which we'll talk about with stablecoins. But there's a lot of technological advancement that's happened over the last couple of decades that allow for alternate networks and rails to deliver a delightful experience, but with the right financial product. Maybe the right financial product is under the hood of a card. So a card essentially is access to a line of credit, but it could wrapper an array of installment loans, each being their own different product, but an easy interaction point with a line, or anything you could imagine on unique kinds of products. So I think that's an interesting piece as we think about unique or personalized credit.
I love it. That's a freaking awesome example. You kind of go back to your co-branded cards. I know we got some mutual friends there with Next Moves that are doing some really cool things. And shout out to to Walt and Steve there. But what Tanner and I keep talking about consistently is bankers really need to think about this, right? Your commercial customers can be your distribution channel, right?
Right.
Like in Texas, you've been here, right? We love HEB. Like Tanner and I can't shut up about this thing. But when HEB went out and launched their card, and all of a sudden my daughter calls me up, she's like, "Dad, 20 years old, going to college, 5% off my grocery bill. That's huge, right?" And I love
Yeah.
HEB. I'm branded with HEB. Well, guess what? You're not opening up an HEB card or account. You're opening up a bank account that's
That's right.
got HEB brand on it, right?
That's right.
So it for the banks on the phone, we keep beating this home. I think you did a great job. I know you did a great job. But this is a way for community banks or any kind of bank to come in, partner up with their commercial customer to go get access to all their customers, right? Without marketing and all the stuff and things.
And those kinds of card programs, typically they've flexed with the lever of reward programs, right? So you think of like, great, awesome, knock yourself out. But imagine a card that works for Home Depot or whatever, and somebody goes and buys a checkout price, ticket price more than $1,000.
Yep.
Great. So you got them into the store with a co-branded card. They used it because they get a bunch of freebies associated to it. That's awesome. But what's the right financial product for them? You could really dial that with adding an additional lever to the basket to say, oh, in addition to rewards, how about we offer flexibility where you could provide duration for different checkouts at the transaction level? So maybe something as simple as And when I say simple, this is pretty cool. It's live in production. It does stuff. But maybe you have like a rule decision process that somebody checks out with a card. They use the Home Depot type card. You notice that they spend more than, pick your number, $1,000 at Home Depot. And you just shoot them a text and you say, "Hey, I saw you bought something at Home Depot, $1,000. Sounds like you got a project going on. Why don't you snap a picture of the receipt and send it to me, and I'll let you know if we can provide different financing options for you post-transaction." They snapped that receipt. You saw they bought a lawnmower for 2,200 bucks. Awesome. Well, that's a sweet lawnmower, first of all. So cool. But also, like, hey, I'll give you a loan. That's a small equipment financing. How about I provide you a loan over, 2 years on that lawnmower? Now it turns into the world's most convenient way of acquiring a loan. As a bank, what would you pay for your acquisition channel to give $2,200 lawnmower loans? More than you would have in what I just discussed. And so there's a lot of flexible ways that you can use these channels to build the types of portfolios of different credit products they might want to do.
I love it. Rick, I've been asking a lot of questions. Don't hesitate to cut me off and ask a question here when we got the expert.
No, I'm fascinated with the whole subject, and I just think that more and more banks are going to be confronted with how to continue to lend, particularly into segments perhaps they're not doing so today. And I think what he's describing is at some point going to be a must for banks to really get involved with. So I continue.
Awesome. Well, I think that's great. So the slide that's been up for a little bit here talks about like now that you've launched a product, fast forward a little bit, maybe you have a portfolio that's out there. What do we see that's happening in the economy? And economists usually like to apply some kind of a letter to the name of the economy shape. And they've added this K economy, meaning there's a group of folks who are doing pretty well, right? The stock market's hitting like a near all-time high or sometimes all-time high each week. We even with the we are recording or we're doing this beginning of March, right? So we see all the stuff happening with Israel and Iran. Oddly, the stock market seems to have most of that already baked into it because there was a 1.5 point drop this morning and it's already recovered. So really interesting to see. But there's a group of the economy who's doing pretty well. So the top leg of the K. But there's an entire cohort of the economy who doesn't feel like they're doing very well, as we had a fairly significant inflation the last number of years coming out of COVID. Stuff feels really expensive. And I use that word purposefully of feels. My wife and I have been married for 21 years now, and our first home that we purchased quite some time ago, our mortgage, including escrow, so escrow to pay for taxes and insurance, our mortgage payment per month was $503. And that was, 17 years ago. That same house today is almost 3.5x as expensive. And and so we sold it a number of years ago, but we actually saw it come on the market a little bit ago and sold. And so the price has gone up in US dollars. And so that was a starter home. It was, built in 1953, and it wasn't, a multi-million dollar house. But as you see that part of the economy, they've got some more pressure on them. And this makes it really challenging for a group of folks that typically, if you were to choose like the demographics, it's folks who are a little bit younger. Maybe they don't have as much of their career. They don't have as much of a participation in the stock market. Maybe they're just coming out of college or whatever, and they feel like barrier to entry is a little bit harder to do. But this also includes folks who maybe have had challenges shifting their skills to what the economy needs today. And so they're feeling a little bit left behind. And that's often one of the areas that we see a lot of our customers serve these folks who need like liquidity or they need like timing of payment. So the example I gave earlier of going to the dentist and or orthodontist and getting braces, well, if I don't have cash in my pocket to pay for that because it's not covered by my insurance, then if my life circumstance is such that I need to borrow, $2,500, $3,500, how do I make as a lender, as the bank, as the brand, as everybody in the value chain, how do we give the right kinds of loans? And so there's three things up on the screen. The concept of how do you manage the credit losses and underwrite accordingly? How do we serve and not have a one size fits all, but be aware there's segments of the economy and some of our measuring rods like GDP and stock market stuff doesn't necessarily represent everybody's personal experience. And I'm going to pause on just those two real quick because there's a lot into that. It's just a lot of background on finance and economics and stuff. But there's perhaps there's some discussion on portfolio structure and management, and then we can talk about what are sponsor banks missing and how can we help on that front.
Rick, I'm gonna let you jump on that one with the economy there.
Well, one of the things that we've noticed recently, just with regard to private credit and the increases that we're seeing there, the last 2 years have been above 30% growth in each of those 2 years. And that total number today looks like about 1.5 trillion, where we see it in banks and loans to non-depository institutions. And that number is growing dramatically. But unfortunately, not a lot of that is flowing down into community banks, into that segment. And I think the hope would be, and Matthew, you and I, Dave, and Tanner have talked about this. How do we uh, uh, get banks, the smaller banks, community banks, more interested in and more engaged in the whole area of private credit, which is a big part of what we're talking about here today.
Right.
And a question I would have for you, Red, is what has been for you? I mean, when you go into something, you design it, you've got a concept in mind, and some parts of that will prove to be true, but there'll be surprises along the way. I'm curious about what maybe some of the surprises have been to you, either in terms of the pace of the growth, in all of this, the participants, just what are some of the things that have really surprised you about this?
Yeah, it's a great question. So, anybody who launches a credit product, by definition, doesn't really know how it's going to take, what's your take rate going to be, but also how it's going to perform. And so,
Right.
having a very strong ability to monitor both of those things and to measure them against what your underwriting model was to see if you're having the desired outcome. So what we've seen a couple of ones, so both surprising good and surprising bad that have these have performed in the past. One, we had a client, so I'll leave them nameless for now, but they were backed by a tech founder that made a lot of money at one of the very large tech companies. And in sort of his years exiting that, he had a pile of money and wanted to create a new finance organization. And so they gave a couple, I think it's about 5,000 loans that were rubber stamped exactly the same terms. And so, if I recall correctly, they're either 24 or 36-month straight line amortized $5,000 loans. And the sole purpose of giving all of those loans, he didn't care about the money at all. The sole purpose was to prove an underwriting model. And could I go ahead and underwrite with this data? And it was to build a score that took the performance over the couple year period to see the predictive analytics of what that underwriting model was. Well, it proved wildly successful, and their business pivoted from being a capital provider to instead selling that score. And so choosing what they invest in, right? They pivoted and adjusted, and it was all based off of, okay, does my score really work? So that was one that's kind of interesting. We've seen others that maybe somebody thinks that they can cross sell, they have a higher cross sell ability. One, we've seen this with a number of institutions that have created fintech organizations internationally, and then they want to come to the US. And one of the challenges with their brand didn't convert as strong to the US as it did somewhere else. So, say you're strong in the UK and you come to the United States. Well, the problem is most folks that maybe even moved to the US from Great Britain don't necessarily have the very top of their identity to be that they're from Great Britain, right? They identify as something else, and that's on the list, but it's not like in their top five identifiers. And so the brand conversion didn't work the same way. And this kind of gets to this final step about the sponsor banks missing, and with some focus just on deposits. If you look at a lot of organizations, their playbook is very similar. Go ahead and build a customer set or penetrate a customer set that is associated with a certain brand so you can capture their deposits. After they build a large enough deposit base, cross-sell them into credit products. That's a lot of people's playbooks. But look what our friends at Nubank are doing. Nubank's strategy has been to do that in the inverse. So starting in Brazil, Nubank has a very large footprint in Brazil of basically everyone who operates with a meaningful balance in their bank account, more than a couple $100, is working with Nubank at this point. So the percentage of the population that they've not captured is pretty down market, and there's not significant expansion TAM available there other than a population growth or an affluency growth. So they expanded into Mexico and Colombia, and now to the United States. But what is their expansion strategy? Well, it's start first with credit. So the idea is I'm going to trust you by giving you a loan. Might be a small dollar, might be a line of credit with a credit card, but it's $1,000, whatever. And then after I trust you for a little while, I build some relationship with you, and then you start to trust me. So I cross sell you into my deposits. So I found that very interesting to see Nubank as one of the most successful players of this has flipped the strategy upside down of I trust you first and then you trust me. But others have approached it from no, trust me first. I'll be your place where you do deposits, and then I'll cross sell you into credit products. So it's interesting to juxtapose those two different strategies. And I think both work. It depends on the market, depends on your brand affiliation or ones you're working with, but also it depends on what the goal is. What are you trying to achieve here? And most of the partner banks that we work with, they're looking for both sides, right? They're looking for a deposit increase, and they're also looking for exposure to their balance sheet or credit products as well. And they can choose a measured approach of how they want to do that.
Rhett, just to drop back just for a minute, uh, would it be safe to say on the underwriting piece that the breadth of data that you guys have now, the amount of work you've done, uh, has really helped you refine that whole underwriting process? And because that's obviously very central to
Yeah.
what you're doing, and certainly something that would be of great interest to those who are coming into a program. So, could you just elaborate on that for a moment?
You bet. So absolutely, right? So if you think about why do you underwrite, it's to apply standards, it's to be compliant, but it's also because when you give a loan, you want to get your money back, right? You want to make some money on the thing. And so you have to have the underwriting that way. So we sort of expand the scope of underwriting to in the shoes I'm in today, what should I do next? So that certainly includes the shoes of somebody's applied for a loan. Should I approve them and what are the terms? But it also makes underwriting include the perspective of how do I manage a line of credit? What's their credit limit amount and should it be adjusted up or down? In the shoes I'm in today, I already gave a loan to somebody. Well, they're asking to change a due date. What's my underwriting guidelines for that? So we like the perspective of that concept. And absolutely, Rick, the data in the platform has helped to feed that. We have something that we've launched that's powered by AI inside of the LoanPro platform. So view us as a system of record that folks use to service and manage loans or any kind of credit product. And one that we have built off of the data set we have in there is called Next Servicing Action. So on the individual loan, what should you do next? And it depends on what you're solving for. If you're solving to mitigate delinquency, if you're solving to maximize, fee or interest income, these are going to be different things, right? So we can use the very large data set we have in the platform, look at the de-identified data, and on an individual loan basis, not only identify like an early warning system before they're non-performant who's going to have a challenge, but what can you do to mitigate the statistical probability of having a challenge on that account? So one example is maybe offering um, a payment plan before they ask for it because the predictive analytics indicate that they're actually an early warning system. You see some behavior in their finances that if you reached out to them and said, hey, by the way, this is a payment program. And that gets down to sort of the sociology of it. When you get into loan portfolio performance, in an odd thing, one of the things that's been most interesting to learn in my career is a meaningful percentage of loan delinquency is psychological, where somebody's embarrassed or they don't really want to have the conversation about the loan servicing. They don't want to call and talk to a human and say, hey, whatever, here's my story, like, let me figure it out. In fact, you find the ones who are proactive that way, barbell. They either have highly performant portfolios because they're super on top of their situation and they are wanting to be very high levels of communication, or the exact opposite. They're just looking for all the ways to not to pay. So it's a very interesting to see the statistical barbell there that occurs. But we do use the data within our platform to provide best practices and consulting to our customers. This is the way to service and manage a loan, which includes all of the underwriting, but the continual underwriting that happens through the life of that account. Awesome. Well, let's move to this next slide here. I want to talk a little about this idea of continuing some personalization and where we're seeing everybody has to do it, right? So we have a really strong thesis that the future of finance is highly personalized. And what we mean by that is let's think of the example of how farmer loans work. And if you went to a farmer and said, hey, you can borrow $2 million to buy all your seed and your fertilizer and everything to run your farm, and I'm just going to put you on a straight line amortized monthly installment loan. Does that work for them? Well, they're going to look at you and say, how in the world is that? So you clearly don't understand farming, right? I have to go ahead and do this. I have to invest. I have to plant. And there's no way I can pay you back until I at least have a harvest. And I think that's a really good example of what the market has already seen with personalized loans. These do exist out there. Some of the challenges that have fought against personalization of loans, because of course, if you're going to provide a farmer a loan, you need to understand what they're going to use the money for, and you're going to understand the cycle that it needs to be tied to the harvest, and that you can get repaid. So they view you as a partner in their business if you have financial products that match the use of proceeds. And so we just want to expand that, but there have been some things that have fought against that over the years, and that's the cookie cutter standardization of securitizing these loans. So if you think about how mortgages work, they sort of rubber stamp, here's a framework fit within a cookie cutter, we're going to group them all together, tranche them together, and go sell them. And that makes sense for the capital markets that they want them to fit in a cookie cutter. So what we found is there's different shapes of cookie cutters occurring over time, and we can help create those, the standards. Rick brought up this idea of private credit really significantly increasing the amount of dollars in private credit. Some of the reason for that is the variety of different personalized credit products that are maybe being funded from a credit facility or a different shape of a cookie cutter that isn't necessarily being securitized. Some of them do get securitized. So we can see non-mortgage asset-backed securities that are starting to grow, and we see some of that side to it as well. So I think that's a really interesting space that what we're finding is that many customers are having an expectation, and let me use the word borrowers. They're having an expectation that the financial institution that they choose understands them and their use of proceeds. And so if you have a financial product that doesn't match what they're trying to do, you're not the right fit for them. And so they'll go find someone that is. But if you do have a financial product that matches what they're doing, they feel like, oh, this is the bank for, or this is the brand for, fill in the blank. And it just is this really strong like personalization match. So I'm going to pause there real quick. There's a lot built into the personalization, but we do feel strong that this is the direction that the world's going in the future. What have you guys seen as you work with different banks?
No, absolutely. Well, take the banks out for just a second and just talk about generations, right? Like,
Sure.
mine and your generation, we were kind of told, hey, this is what's going to be. And we just kind of went out and did it. Our kids, though, especially mine and yours, at this age, everything's customized, right? You can customize everything. So what it makes sense that your customization of your loans, your financial accounts, whenever they say, wait a minute, this is cookie cutter, they don't expect that. They're going to expect the customization. And the other thing, when I really like what you're saying is I'm watching my daughter transition. If she's getting ready to graduate from college, life is changing, right? So all of a sudden now she's going to need a little bit more personalized products that's for her, as wherever her life is going to take her. And I think as you go in and you can customize these loans and say, wait a minute, you're getting ready to have your college loans. Maybe we need to pause for a second as you transition over from student to work and get your new rent and everything. Can we customize this for just a little bit? You're going to get a customer for life, right? If you go in there and you really help these kids out. So I think it's two things. One, I think it's generational, right? I think the younger generation, or at least my kids and your kids, are definitely in tune to this customization. And the banks and or the financial industries that can go meet these customers where they are going to have customers for the rest of their life, honestly.
And I agree with you. What's interesting to see is how many financial institutions are organized, is siloed by product offerings. Often those product offerings are aligned to phase of life. So you'll find institutions to be organized to be, during like student, newly married, new how, like they'll organize by a highly predictable maturation that a customer set will go through.
Mhm.
And since you view it as so highly predictable, what's fascinating to me is the organizations are designed in such a way they have to reacquire the customer. So they have to get that like they know that they're going to graduate out of a certain business line,
Yeah.
but they don't coordinate with the next business line to like have a white glove handoff. Instead, the next business line has to acquire them. And that's done for all kinds of reasons. Like we don't have time to get into the reasons why it's done that way. We just don't think that that's optimized for the customer's experience, and that the future is going to demand that seamless like journey. I call it a chameleon. Like if I'm a borrower, I don't really care what you have to do on your side. Like you figure it out. My product should evolve with me as I evolve. And we certainly provide the technology stack to do that. We're seeing the most success with folks who choose to launch products that truly understand their customer.
I love it. I laugh because I said this on stage about 3 or 4 weeks ago. It's like, you think about banks, we're so siloed, and I think we've got to break down those silos and focus on our customers as a journey, focus on our commercial customers to say, well, it's not just a loan, or it's not just
Right.
merchant services, or it's not just this. It's like, what does our relationship as a whole look like? And I think that's really where we're going to get to, which I'm sure me and you could go on a soapbox for the next 2 hours on. But I think we're getting close to time. Do you have
Let's jump the last slide here.
Yeah, of course.
All right, so the very last, I'll just be very brief here. A little bit of a teaser. There's some cool stuff happening with stablecoin,
There is.
right? So stablecoin, if you think about it, and I'll leave them a couple minutes at the end here, but we're heavily involved in stablecoin. It's one of the things that we're supporting, and what I think is so neat about it is that it provides a really great alternative rail of moving money, and you should consider should you be involved with stablecoin. So I have not been the biggest supporter of crypto in the past. As you look at crypto, it's not really my thing. I have sort of this requirement of my own financial investment that I want to be able to see two different ways of making money off of an investment. Maybe it will appreciate in value and it pays a dividend or whatever. And I've been wrong on some things in the past. And if you would did this big like a hump of crypto and it's grown like crazy, but what am I in love with crypto? Well, the technology. In fact, if you talk to most people about crypto and you start going through the concept of like, hey, does it have stability and so forth, they'll always come back to the technology. And yeah, I think everybody's aligned that blockchain's pretty freaking awesome. It does amazing things. It's great. It's a better ledger. It has great, immutability, all these things. And that's what I love so much about stablecoin is taking the advantages of crypto, using the blockchain, but pegging it to the US dollar so you don't have the volatility. And what we're seeing is it creates also basically an alternate rail of moving money. And if you look at that, people have money sitting in a wallet or a store value, and then they can spend it. So it looks basically like a parallel rail to a debit card, right? Well, we're supporting these folks of how would you do that with credit? A lot of folks talk about credit. Their first stablecoin credit concept is from a crypto perspective of more like a margin loan. I have a basket of assets that I can borrow against. Cool. We support a bunch of those. What I mean is, I don't have money sitting in a wallet and I want to go spend. Can I have a line of credit that when I spend, it's a draw on my line? And we support that. There's a number of things that has to be right to support that long tail that Visa and MasterCard are investing in. Really, all the networks are sort of becoming networks of networks, and we're helping support that process. Where the idea is, if you look at the fastest growth area of both Visa and MasterCard, it's going to be their value added services, slightly different names between the organizations, but the value added services areas. And it's because they can offer some amazing things like I call it deal with it later. So, if you buy something on, I say this often, if you go to Craigslist and you buy something and you pay cash, if there's a problem with that thing, when can you deal with it? Like when you bought it. Like when you hand over the cash is when you're going to deal with that issue. And if there's a problem afterwards, there's like low levels of comfort that it's going to be solvable, right? So, but if you pay use your card to do it, you can. There's some structure and rules to deal with it later. That's something that there needs to be some protocols and rules that we're helping build with a couple partners. When you buy something with a new wallet instrument of a stablecoin credit, this is what we're envisioning, and like it has a framework of how all those rules work akin to like chargebacks and so forth, and how that's funded, providing the real timeness and the convenience of stablecoin, but also what's the right financial product, because it could be an installment loan proceeds, it could be a variety of these different ways. So I know we spent a bunch of time there, but we're pretty jazzed about what we're working on stablecoins, but it fits within the theme of personalization, meeting
Right,
people where they're at, using the
right.
products that they want to, and providing the right team. So for banks, if you're looking and you're interested in um, playing different roles within this organization, like if you're wanting to be the capital or the license or the bin sponsor or framework, then would love to have a conversation. We support many today, a sizable footprint across the United States, primarily the US, but we're happy to help you in that process.
Outstanding. Let's talk about that some offline. I'm anxious to see where that's headed, my friend.
That'd be great.
All right. Well, I can't say thank you enough. I really appreciate you joining. I know it's good catching up with you, and I enjoyed the conversation. Thanks, Rhett.
Yeah, hey, thank you so much, and nice to see you guys. Look forward to all the great things that are happening and that help. I know one of the things I like most about the relationship is help make the future together. Let's do this thing.
I love it. All right. Have a good day.
Thank you. See ya. Bye.